Hi everyone. The most noisy debate in the past 1 month has been trade tariffs by US on all its major trade partners and its impact on the exporting economies. However, a large tariff on all US imports will only harm the US more than other countries. Ultimately, the higher tariffs will be paid by the US consumer through higher inflation. US inflation has remained stubborn, providing further evidence that achieving the last mile of inflation decline will be challenging. Tariff uncertainty will also discourage capex and growth initiatives in US. Counter tariffs from other countries will also impact US corporates who have global businesses. Hence, it is very likely that US growth will also slow down. Higher inflation and slower growth is the combination that US equity markets may not like. Indian markets have also experienced a sharp correction. The fall in the equity markets is a result of confluence of headwinds, which are slowdown in corporate India earning growth, noise around US trade protectionism, relative outperformance of other emerging markets, and FPI outflows. However, amidst all these noise, markets have been ignoring some positive developments that are happening around us. In the union budget this year, the government has signaled a transition to a more balanced fiscal approach between capex and consumption. Income tax cut will increase disposable income in the hands of middle class consumers, which should spur urban discretionary consumption. Secondly, RBI has also taken a more accommodative monetary policy stance. First, it reduced benchmark interest rates by 25 bips and then followed it up by several measures to improve system liquidity. A second round of 25 bips of interest rate cut has also a reasonable probability. Thirdly, the political mandate for the union government has been reinforced by two favorable state election outcomes. There have been also some early signs of demand improvement as indicated by our internal channel checks and higher frequency economic indicators. Coming back to the markets, Nifty corrected close to 6% in the first 2 months of CY25 and 16% from the highs achieved in September of 2024. When discussing corrections, most people focus on price corrections. However, valuation correction is something which is more relevant. In the case of large caps represented by Nifty 50, valuations are now close to their long-term averages. Mid caps and small caps remain above their historical averages. However, recent correction in broader markets has resulted in some pockets of valuation comfort even in these categories. Calling a market bottom is difficult, but it is evident that valuation comfort has improved, particularly in large caps. India offers a long-term growth opportunity for equity investors. It is the fastest growing major economy globally, with double-digit earnings growth expected over the next few years by Indian corporates. It has amongst the lowest debt to GDP and best fiscal consolidation since COVID-19 among the major economies. Indian banking system is well capitalized to support domestic growth, while Indian corporate sector also has the lowest leverage in many decades, which insulates it from macro risks. Corrections triggered by global macro uncertainties have always been a great time to buy Indian equities historically, and this time is no different. Happy investing. Thank you.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.